Relying only on a paycheck means the month you lose work, groceries go on a credit card, and the balance grows before you can stop it. People treat investing as optional and leave spare cash sitting idle because it feels safer and they plan to start later. Money that could be buying assets is doing nothing. It is not earning dividends or interest, and its buying power is shrinking. You finish a long day, tell yourself you will learn this on the weekend, and quietly, another month passes where only your labor pays you and nothing else does. Passive income from investing is money paid to you because you own something, not because you showed up for a shift. It is the opposite of trading hours for dollars, and that difference matters when life throws you a schedule you did not choose. Your job can pause or end. Ownership can keep paying. This is not a hack or magic. It is simply how capital works. Investing creates passive income through assets that distribute cash, businesses that share profits, loans that pay interest, and property that collects rent. When you buy a share of a broad stock fund, you become a tiny co-owner of many companies. When those companies make profits and choose to distribute them, you get a slice. When you hold a bond, you are the lender and the borrower pays you for the privilege of using your cash. Real estate funds can pool rent and pass it through to owners without you fixing anything on a weekend. Here's what this looks like in real life. A coworker sets up automatic contributions into a diversified fund and checks a box to reinvest payouts. A few times a year, the fund sends out cash and the broker uses it to buy more shares without the coworker lifting a finger. Over time, those extra shares themselves start paying, and the snowball of payouts gets heavier. Compounding is what turns small payouts into a meaningful stream. Reinvested cash buys more assets, those assets generate their own cash, and the loop repeats. Early on, the numbers feel underwhelming. That is normal because the base is small. The job in the beginning is not to judge the trickle, it is to keep feeding the machine so the base grows. A broad stock index fund might pay around 2% in cash distributions in a typical year, which sounds tiny at first. That is not the whole point. The companies inside can also grow, so the fund's value can rise while it pays you. In other words, the cash is just one part of the total return, and the growth of the base matters more than the early checks. Yield is not a promise. It is a current snapshot of cash paid relative to price. When prices drop, yields look bigger even if nothing actually changed about the business. Payouts get cut when profits shrink or priorities shift, and no company or fund owes you a fixed check forever. Chasing whatever prints the highest yield right now is how investors end up buying headaches they do not need. The most common beginner mistake is building a portfolio only of high-yielding stocks or funds because the checks look impressive today. That can mean concentrating in a narrow set of industries that all move together and all cut payouts when the same pressure hits. You also ignore companies that reinvest profits into growth instead of paying them out, and you miss the compounding that comes from that reinvestment. The result is fragile income that bounces at the worst times. The cost of that mistake shows up on your bank statement and in your timeline. Income that looked large gets slashed, the share price falls, and now you need to sell more shares to cover the same bill. You pay taxes on distributions you did not need, so more of your cash goes to obligations you could have deferred. You also end up reacting to headlines instead of following a plan. Here's the correction. Build your core with low cost, diversified funds that own many businesses across sectors and regions. Use automatic reinvestment while you are still building so the pile gets larger without you babysitting it. When the portfolio is truly substantial and your work income is less critical, then you can decide how much cash to take out and how much to keep compounding. Bonds exist for a reason in an income plan. They make scheduled payments, they respond differently to stress than stocks, and they can be matched to dates when you know cash is needed. A simple ladder across different maturities can stagger interest so deposits show up through the year. Stocks drive growth. Bonds add structure and calm to the cash flow. Taxes matter because not all income is treated the same. Interest is typically taxed at your regular rate. Some stock payouts qualify for better treatment, and real estate funds can have their own wrinkles. That means you want to place income-heavy assets inside retirement accounts when possible, and keep tax-efficient growth assets in taxable accounts. This is called asset location, and it is one lever you control without forecasting markets. When it is time to live on a portfolio, a conservative guideline many planners use is about 4% of the portfolio's value as an annual starting withdrawal. That is not a guarantee, and it requires flexibility in tough markets, but it frames the relationship between the pile and the paycheck it can safely send you. You still adjust based on conditions, but it keeps you from demanding a paycheck the assets cannot deliver. Sequence risk is the reason you do not anchor your lifestyle to the peak checks from a bull market. If bad returns show up early in your withdrawal years, taking the same cash out anyway can dig a hole fast. The fix is to build a reasonable cash buffer, adjust spending when markets are rough, and keep a portion growing so the engine recovers. This is not complicated. It just requires you to stop treating every payout as spendable. Cash flow is also about timing, not just totals. Payouts do not land on the same day your rent or mortgage does, and they vary by month. Set distributions to feed a holding account, then move a steady monthly amount into checking so bills get paid on the same schedule every time. This is a small system change that removes drama without changing your investments. Fees take a bite out of every future check, and you do not see the full cost until years later. Paying 1% a year to own something that looks like a broad market fund is not buying you skill, it is handing away compounding. Choose low-cost funds, verify the expense ratios, and avoid layered advisory fees on top of expensive funds. Keeping costs low is guaranteed return you control. Risk management keeps your income alive when the market throws a tantrum. Do not pile into your employer's stock for the story of loyalty, because your paycheck and your portfolio would be tied to the same fate. Spread exposure across industries and countries so one event does not shut off the whole faucet. Rebalance on a set schedule so winners do not run unchecked and losers do not starve the plan. Your behavior is the lever that matters more than your hot take on the economy. You do not need to predict rates or inflation to build an income engine. You need to contribute regularly, reinvest consistently, and ignore the urge to yank the wheel every time a headline shouts. Passive income arrives because you stayed in the game, not because you guessed the next plot twist. Real estate is often called passive, but direct landlording is a side job with tools and techs at odd hours. If you want exposure to property income without fixing anything, public real estate funds are a simpler path. They still fluctuate, and their payouts change, but you get diversification, liquidity, and no calls about a leaky sink. If you insist on buying a property, run the math like a business and pay yourself a real wage for the time you spend. Starting is mechanical, not mystical. Open a brokerage account you can understand, link your bank, and automate a transfer on the day after payday. Pick a broad market stock fund and a high-quality bond fund, set distributions to reinvest, and leave them alone while you keep contributing. Write down your target mix in plain language so you do not reinvent your plan in a panic. As income shows up, make a deliberate choice with each dollar. If you are still in the building phase, send it right back into the portfolio to deepen the base. If you carry high-rate debt, redirect payouts to kill it, because every dollar of avoided interest is a sure return that beats most guesses. Later, if you need cash to fund a goal, set a realistic draw that your assets can sustain through a boring year and a rough one. The key shift here is to stop seeing your work as the only engine and start seeing assets as employees that never sleep. You're moving from chasing windfalls to building a system where money earns money while you handle life. That change from effort-based income to ownership-based cash flow is the quiet backbone of stability. Next, we will tackle what is a credit score and why it matters, because the price you pay to borrow either protects your growing income stream or leaks it away.